Everyone is looking for the next big stock to buy, but I'm focused on something far simpler and way more powerful. There are 7 stocks that I will buy nonstop this year and over the next decade when they sell at the price I need them to sell at. And right now, they are quietly beating the market, even in a year filled with war headlines, trade tariffs, constant volatility, and all-time highs being hit all the time. I call them my personal Magnificent 7. No hype, not inflated, just smart, undervalued businesses that the market keeps missing. And these 7 stocks could be the start of something massive. So here's the deal. Everyone has been obsessed with the Magnificent 7. Before that, it was FANG stocks, and things change all the time. But I love challenging that narrative. So earlier this year, I picked 7 under-the-radar stocks that I owned that I believed would beat the market, but also the so-called market leaders. And guess what? So far, my 7 stocks are winning, but the funny thing is, it's a tale of 2 quarters. I said that we would be doing a quarterly update, and the difference between the first quarter and the second quarter is massive. And if you stay until the end, I'm going to explain why that is. Now, I want you to keep in mind, this is not I called it victory lap. Even now on Instagram or Twitter, I get people messaging me saying, Paul, because of your philosophy, I'm beating the market. I'm like, guys, thank me in years, not in months. Months have nothing to do with performance. Anything can happen in month to month. Now, when it comes to my Magnificent 7, there is one thing that I have called that I will take the victory lap on. But from day one, I said we would track these picks quarter by quarter and compare them directly to the Magnificent 7 and the overall S&P 500 as well as the NASDAQ. This isn't a prediction. It is going to be a scoreboard. Every 3 months, I'll be back here to show you exactly how things stand. Guys, this was the first quarter of my Magnificent 7. I'm here in purple. In whatever color this is, orange is the S&P 500 total return. In blue is the actual Magnificent 7 and the NASDAQ in green. So my theory, Mo, we talked about this all the time.
Yeah.
The most hyped up stocks, what do they do when things are bad?
They're going to go down the most.
And when things are good?
They're going to be up the most. They're the market leaders, both directions.
Absolutely. And we've said this from day one. And look at this. NASDAQ is down 10.3. The Magnificent 7 is down 15.7, S&P only 4.3, and I eked out a gain of 1.12%. Now, these are all 7 stocks that I own. But again, like I said earlier, it's the tale of 2 quarters. Let's look at the second quarter of performance because it is a night and day difference. If you recall, we hit a bottom around April 8th or so, give or take, the start of the quarter. And since then, oh, my Magnificent 7 was so boring. Only up 5%. Look at the S&P 500, up 10%. Look at the NASDAQ, up 16%, and the Magnificent 7, 19%.
Leading the market again.
Still in line with our thesis that when the markets are up, the Magnificent 7 is going to crush and we're going to lag. When the market's down, we're going to beat that. Yep. So you might be wondering, well then, Paul, how can you say over years and years to come that you'll outperform? Mo, what's the reason we think we'll outperform in these 7 versus the other Magnificent 7?
Finding the right valuation.
Right. We think this Magnificent 7, the real one, is massively overvalued. We think ours are undervalued. So we think that in a down, sideways or down market, we will outperform. Now, it's not a timing mechanism. What it is about saying it makes perfect sense. When you're paying more for something, your returns will be less. If this iPhone is worth $1,000, you make more money if you pay $100 for it versus $1,500 for it. That's it. It's very simple. But we overcomplicate these things all the time.
It's also very difficult to stomach a 40% swing.
Yeah.
I mean, I'm just rounding 20.
Well,
20,
look at
19%.
NVIDIA.
Yeah.
Mo, NVIDIA started out down 35% and then rebounded up 65%, all in the first 6 months.
That's crazy. That's absolutely crazy. It's hard to stomach as the average investor.
Oh, and by the way, I want to make note, the quarter is not over yet because it's June 30th as we're recording this, but it's basically going to end up something like this. Yeah. But guys, I really want you to focus on, I have no problem looking at this and going, oh, I underperformed in the second quarter. I don't care for 2 reasons. 1, I believe in the long run. And 2, this is a short-term part. You cannot decide if you're right or wrong based on what happens in a month or 2, unless there are other investments you're making in small companies, things that have catalyst events that could trigger value. That doesn't happen on multi-$100 billion companies though. Now, I'm going to walk you through each of these 7 stocks one by one. I'll show you exactly why they made the list, break down their fundamentals, and most importantly, reveal the price that I'm personally waiting for before buying more. But real quick, this is year to date on the Magnificent Seven versus mine. I am just up slightly on the S&P 500. I'm up 6.35. S&P is up 5.65. NASDAQ's up 5.34. And the actual Magnificent Seven is only up 2% year to date, which is crazy considering how much volatility has been and how big the run-up has been lately.
That is crazy.
It's absolutely nuts. I would have thought, based on this last quarter, that I was trailing.
Me too.
I would have absolutely thought that.
Yeah.
So first quarter, I won. Second quarter, I got pummeled. And for the first half of the year, I'm up slightly. This is not a victory lap. There's no way it's going to be a victory lap. It'll be a victory lap in a few years when the NASDAQ does what I think it's going to do. So stock number 1, Ulta Beauty. A quiet beast in a $100 billion industry with over 1,300 stores and 40 million loyalty members. They dominate combining drugstore, prestige, and luxury brands all under one roof. But they don't just sell products. They offer salons, services, and tech-driven experiences that build serious customer loyalty. E-commerce now drives over 20% of sales, and Ulta is leading hard into AI. This isn't just hype, guys. They are a high-margin, cash-generating business in a timeless industry. So let's run through the 8 pillars and see what price I'd actually buy it at. So, Ulta, $21 billion company, $24 billion enterprise value. The reason this matters is this is retail, and this difference here is their net debt. Not a lot. It's only $3 billion on a company that generated $1 billion last year and averaged pretty much $1 billion a year in free cash flow over the last 5 years. High returns on capital, which shows that they're able to generate profit on the money they put into their business. Mo, you ever go to an Ulta?
Mm-hmm.
So have I, and I just think it's an absolutely beautiful store.
Yeah, they do a good job in there.
I think it's a great place to shop.
Yeah, they do have really good I like the online part.
Do you?
They have a good website.
Oh, I don't even pay attention to that. Yeah. I haven't even gone there. Now, what's interesting is, if you're a community member of ours, guys, remember, you can go vote on what you think. What's interesting here is the average rating by our community members is hold. Now, that might be because of the recent run-up in the stock, because in the last year, it got as low as 309. So that was a lot different story than 470, because, guys, remember, to be a true investor, you have to understand one basic principle. When price changes, your thesis changes. So what that means is, in our tenets of principle-driven investing, the great story at the wrong price becomes a bad investment. If you don't understand that concept, you've got to take a step back and really, truly understand that. And sometimes it takes a little bit of difference. Like I said, this phone is awesome. This is the best phone ever made. Pay $10 million for it. No, that's ridiculous. Pay $1 for it. It's the best thing ever. Same phone, different price, different investment thesis. This might sound obvious if you've been watching us for a while, but it's so important for you to understand that and to understand these metrics. Let's go look at the 8 pillars. Mo, look at this. We got an 8-pillar thriller. Buying back shares, high returns on capital. Look at this. So, Mo, 5-year PE was 20, 5-year price of free cash flow was 21.6. When the stock was at 309, how much different was that? We were below 15 on both of these metrics.
Yeah.
That's the difference. It makes a huge difference in your returns when you pay a cheaper price. That's what's really important. Okay, let's go look at the analyst estimates. 50% growth in the earnings per share according to analysts over the next 4 or 5 years. That's a lot of growth.
That is a lot.
Revenue, basically coming along here. 3%, 5%, 5%, 5%, 5%. So it's not a big grower. But again, if you pay the right price, that's okay. So guys, then it leads us to the obvious question. What's the right price to pay? This is something that everybody should be asking on every investment. Because if you just attach yourself to the story, there will be no price too high. Because the story is always good. I always talk about this, especially with like something like Bitcoin. When I hear Bitcoin people talk about why Bitcoin is great, none of it ever has to do with price relative to value. It's always, it's changing this, it's doing this. And I always say to somebody, okay, fine. Add a 0 to Bitcoin's price. Is everything you said true? Yes. Take 2 zeros away. Is everything you said true? Yes. Well, then it's not an investment thesis. With any stock you're buying, There's a story and there are numbers. You got to put them together. When you put them together, adding and subtracting digits, a zero here or there, is going to massively change the investment thesis. As I said, let's say Ulta is worth 467. What about 4,670? If you're a value investor, you'd be like, absolutely not. What about $46.70?
Oh, yeah.
I'm selling your soul, your parent's soul, your dog's soul, every person you know to buy Ulta at $46.70. That's the difference. Anytime somebody tells you how great a company is and they don't mention the fundamentals, then they're not investing, they're speculating. Now, Mo, tell us, before we get in a stock analyzer to put all of the story numbers together, there are other ways of making money. Doesn't matter what the fundamentals doing. Tell us about trading.
Yeah, that's true. So something interesting about Ulta is because it's kind of bounced around that 350 to kind of 450, that range. Here, I'm zooming this chart way out, and you can see that it just consistently stays in this range. So right now for me, Ulta, I'm not super bearish on it or bullish on it from a trading perspective. Why? Because if you see where my whiskers are, this right here is like a steel I-beam. It's very difficult to get above this level. Now, what can push it above that level? Good earnings, good volume coming into the stock, people pushing the stock up in the right direction. But for me, and you see this gap right here, I would be waiting on this. I would wait for this trend to start turning down. And to me, I would be looking at it to go short. But remember, this is just in the interim. This can be a couple weeks. This could be a couple of months. I'm not looking at it from the same perspective we're looking at over here on this board.
Yeah, this is totally fundamentals driven. So guys, this is our stock analyzer tool. It's used over 1 million times per year by our users for exactly this reason. I did a 10-year assumption, 10-year analysis. Here are my assumptions. Revenue growth. I did 3, 4.5, and 6%. Nothing crazy, nothing insane.
Actually kind of low.
Slow and steady. Profit margin did 9.5, 10.25, and 11.
I like that.
Same with free cash flow. Now PE, it's still in the retail space, so I went a little bit lower. I did 15, 18, and 21, even though their returns on capital are high and getting better.
Yeah.
But still, and by the way, some would argue, Paul, and I would argue, put the PE in relative to this return on capital and this growth rate and have your margin of safety and the desired return. Because guys, I put 9% here, but that's a market return. There's no margin of safety in that. I'm just showing it to say this is what I think the company is worth. But in order to buy a company individually, you need to have margin of safety because we're humans and we make mistakes and the future is unknown. If we know what's going to happen in the future, we'd pay a lot different price. Look at NVIDIA.
Yeah.
If you bought NVIDIA 5 years ago, you had no idea AI was going to happen. And if you claim otherwise, you're a liar.
Yeah.
But that's the difference. So I hit the analyze button. Now here's the difference. The stock's at 467. Well, look at this. I have a low of 366, a high of 655, middle price of 492. At 467, the cash flow return is only 9.7%. Mm-hmm. What is it at 309? Probably around 15% or so, maybe higher.
Right.
That's the difference that price makes. Stock number 2, Sprouts Farmers Market, up nearly 22% this year. It's at $162. Mo and I started buying in the low 30s. This is not hype. And nowhere do I think that buying at the low 30s means this thing is going to go to 1,600 someday. Sprouts runs smaller stores, higher margins, and they target health-conscious, affluent shoppers. While big grocers fight for the pennies, Sprouts is quietly winning by expanding into wealthier areas, and more importantly, they're growing their private label offerings that have massive margin. Mo, do you remember what the margins are on their private label offerings? Considering that their current business is 38% gross margin. Do you remember what it is?
No, is it 10, 11%?
No, in terms of the private offering, no, it's like 50 to 60% margins.
Really?
Oh yeah, it's huge.
Wow.
So and it's taking up a bigger part.
I don't remember that.
It's a bigger part. As time goes on, they're selling more and more of the private label.
Yeah, so I've gone to their stores before. They do have a lot of private labels now that I'm thinking about it.
Because it's so much higher margin. Guys, a typical grocery store like Kroger
look at
makes
Costco.
1 to 2% bottom line margin. Costco does like 2.25.
Yeah. Mm-hmm.
This is 5.53 last year and 4.46 average for the last 5 years. So it's increasing.
That's great.
This could be a business that does 7 to 8% bottom line margin.
Which is insane in the grocery market.
Insane.
What's Kroger, like 1.8% or something?
It's around there. Now, even better, guys, their goal is to get 12 to 1,500 stores. They currently have around 500. So they're going to over double their store count, maybe even triple. and they're going to scale in a smart way without chasing reckless growth. It's profitable. It's efficient. It's exactly the kind of overlooked business that I love. It has a long runway of growth with really good margins that are getting better. So let's analyze it together, and I'll show you price I'd buy more shares at. Now, again, what's interesting, look at this. Sell.
Ooh.
Probably, again, if you're,
maybe.
Guys, I cannot stress this enough. In your community, go vote on these things. This is absolutely a great way for us. And pretty soon we're going to have boards on each company where people can put their thesis and talk about each company individually. That way you don't have to go in the community and search for it. It'll be right there at the company. $16 billion market cap, $18.3 billion enterprise value, growing free cash flow. Mo, look how close their free cash flow and their net income is.
Basically the same.
Basically the same. But we have high multiples.
Yeah.
33 times free cash flow, 36 times earnings. Remember, guys, that alone doesn't mean that it's overpriced.
Not at all.
A fast-growing company can justify a much higher PE and much higher price of free cash flow. Much higher. Yep. All right, let's continue on here. 8 pillars. What's your guess? How many checks do they have?
I saw this. I'm going to say valuation metrics are elevated, and I don't know what else it would be. Oh, I missed the long-term liabilities.
But you know what? They're growing, and I'm not worried about this.
Yeah.
And it's retail. They gotta have the store leases in there. I'm not worried about that. But these 5-year PE and 5-year price to free cash flow, even though it's growing fast, you've got to remember it still feels a little expensive. But remember what Charlie Munger says. For high returns on capital for great businesses, paying what might seem to be an expensive price wouldn't be expensive. Kroger growing at 3 or 4% a year is a lot different than Sprouts Farmers Market growing at 7 or 8% a year, if not higher.
For sure.
That's the big difference. So, Mo, analyst estimates. Actually, I'm surprised by this. I thought it'd be higher.
Me too.
$5.15 a share to $8 a share in the next 3 or 4 years, which is good double-digit growth, but not as much as I thought. But look at this revenue growth,
Higher revenue
Mo.
growth than I thought.
Yeah. Basically 10% a year.
Yeah, it's really solid.
So take us to the charts, Mo, because it's really, there's a lot of this stuff we just threw at people is overwhelming. And if you do feel overwhelmed, you're not alone. We are here to simplify all of this. Keep in mind, guys, when you went to college, you went to high school, you didn't learn everything on day one. It's really, really, really important that you sit here and get an understanding of our foundations and our fundamentals and what we believe. The more videos you watch, the better it'll be. I will tell you guys, our stats show us that the people who stick around and watch a few videos really get it, and they watch tons of videos of ours. That tells me that people who stick around learn a ton more, and if you watch a few videos and get a better understanding, I can assure you, you'll have a better understanding than 99% of the world when it comes to investing. Mo, let's look at the charts.
So I drew these two perpendicular lines here, and you can see that the trend is starting to come down. We're coming down through this sweet spot area, which is the area that you're going to make the most money, highest probability to make money. And the reason I drew these lines is very similar to Ulta. We're in that kind of range-bound area. So you can see, does Sprouts pop above this yellow line? Yes. Does it go below? Yes. But it always kind of finds itself back in that consolidation channel. So anywhere from 155 to 175, you're just kind of stuck. So the best place to trade this is on a swing trading chart. Why? Because you can trade it between 1 to 10 days. You're in, you're out, you're in, you're out. It's not something long-term. When you're in a consolidation channel of $20, it's really hard to make long-term trades on.
So when you're saying that 155, 175, if it breaks 175, look out on the high side. If it breaks 155 on the low side, look out on the low side,
If you have volume. If let's say you break 175 on the top, you have to have a lot of buyers to keep it pushing up. Because we've seen it go to 180, but what happens when it hits 180? It just comes right back down.
So it broke 175, but didn't have the volume to do that.
Exactly. So if you have volume, you can break and just keep going.
Nothing we said there had anything to do with fundamentals.
Nothing.
That's what's important. Okay, so here's my stock analyzer tool on Sprouts. 10 years, I did 6, 8, and 10% revenue growth. A little bit lower than analysts were saying, but I feel comfortable with this. Mo, this is where I want to change. My historical profit margin, I did 4.5, 5.5, and 6.5. I want to change this because of this. I actually want to change this to 5, 6.5, and actually 8.
Okay. I think it's fair. I mean, the trajectory is there.
I did 16, 19, and 22 on the PE and price of free cash flow, and again, our 9% return.
Okay.
I hit the analyze button. So guys, I have a low price of 81, high price of 217, a middle price of 136. So I do think that this stock is maybe a little expensive right now.
This is based on 9% return.
This is based on 9% return. So to have my margin of safety, I probably need to be buy. My guess is probably under 100. What would that take? So here's one way to see what the right price is. Let's do 13% returns. Making my assumptions about, oh, look at that, Mo. $100.
Yeah, $100. Okay.
So I'm going to add this to my watch list at $100. It was at 75, but I'm going to add it at $100. And as time goes on and the fundamentals get better, I will change that number as time goes on. Next up, Southwest Airlines. Guys, I believe this is the anti-airline airline. Airlines are such a tough business. They rack up tons of debt. They have chaos. They have so many issues. Southwest, up until COVID, had 47 years of profitability. That's not luck. That's strategy. That's process. That is implementation. One aircraft type. They stick to the 737. Lightning fast turnarounds, smart fuel hedging, and they focus on profitable routes. Now, with fuel-efficient planes that are getting newer, expanding their routes, and business travel bouncing back, I don't think this is as much as a gamble as a well-run machine that is currently experiencing a slight issue in their numbers. If any airline's going to pay off long-term, I believe it's Southwest. Now, the thing about Southwest is very simple, Mo. What's my overall thesis on Southwest?
Getting those margins back to normal.
So you look at this margin right here, 2% in the last year, negative 0.65. Prior to COVID, guys, it was 10% to 15% very consistently. Now you might be wondering, a lot of people have said, no, this is garbage, this is garbage. Our community members like this stock though. The average 7 community buy rating doesn't mean go buying it, but you sit here and look at this going, what if they get to that 10% margin again?
Yeah.
What if they just get to 8% margin again?
Right.
People would say like, well, I'll never do that. Really?
Well, why would it not do that? It's just going to take time.
They had very specific issues. That 737 MAX issue has cost them hundreds of millions of dollars.
Yeah.
There are computer issues that they're upgrading. There's a lot of issues there. And now there's some activist people sitting here trying to help them. Now, guys, it's really important to slow down here because I think a lot of people really miss the big picture. We're sitting here and this is a company where I look at the 8 pillars, don't care.
Yeah. I think another thing, like I pointed this out in the video we recorded last week, they never lost money until COVID. Like I think you don't see that.
And when they lost money in COVID, it wasn't like they lost billions and billions of dollars in a year. They lost I mean, we can look it up right now.
And think of what it took for them to lose money.
Yeah.
The government said you cannot fly on planes.
Correct.
Like that's what it took.
Yep. 1 year, they lost $3 billion.
And they rebounded right back to profitability.
Yeah. It was, by the way, it took literally the world shutting down. Remember?
Yes.
I think I was with you the first time I saw a plane when COVID.
Yeah.
We were driving down 77 to Cleveland. I was like, oh my God, there's a plane.
Yeah.
That's how nuts it was.
Yeah.
So when I look at this, I look at the 8 pillars.
Clearly a well-run company.
But this is not this is useless information to me. Now, they were diluting shares for a while, but they've started repurchasing shares back because obviously, hopefully the people who are in charge are seeing the value there. Let's look at the analyst estimates, Mo. I'm sure this is going to be insane.
Just noticed this is $32 a share.
$1.18 to $4.25 a share. I'm actually surprised. I think this is kind of low.
Yeah.
$4.25 per share. But at 20 times earnings, if you believe in this company being a premium company, that's 85 times.
Right.
$85 per share, I mean.
Right.
That's a big number.
Yes.
Big number. Revenue growth, not much.
No.
But record revenue every single year.
That's the
record
thing.
revenue. Well,
Yeah.
except for that year. Now it falls here. So Mo, let's look at the charts. When you're looking at this company, and this thing has been stuck in the low 30s, high 20s for a while now.
It has. And this is interesting. This is what I call a 50% stock. So here I'm going to draw a couple lines here. Here's your high. That wasn't a very good line. Here's your low. And then the middle ground is this 50% area. Why is it 50%? You see all this blackness right here? That's just negative pressure just pushing down on the stock. So what happens is people that lost money right here, came all the way down, they say, if I can get half my money back. Stock price comes up here halfway, falls back down. Halfway, comes back down. We're at that halfway point. What pushes something through that halfway point to go back to, say, $50 a share? Goes back to what I said on the last stock, it's volume. Volume drives everything in the market. If you don't have volume, you're not going to break out to new highs that have been going on since 2022. Buyers.
Yeah, but I mean, like, so if the normal volume is 100,000 shares a day.
I would like to see multiple days, probably like 10 days in a row of 120,000 shares a
So
day.
a 20% premium for
Yes,
10 days.
with buyers, just pushing it through. That's what it'll take it to that new level. I'll draw a new line, it'll be a new base, and then you build from there.
Awesome.
Yeah.
Okay. So guys, here's my stock analyzer tool. 2, 4, and 6% revenue growth. 8, 11, and 14. Guys, I put my highest number at a number that they've hit before. Yeah. So I'm still putting 8, 11, 14. PE, I did 14, 17, and 20. I did a 9% return. Mo, watch this.
This is going to be very green.
Very green. A low price of 52, a high price of 152, middle price of 92. The lowest return is 16%, the highest is 35. Do we know this is going to happen? We have no idea on any individual stock. But if I had 30 companies in my portfolio that had all of these, I am going to do quite well. Quite well. As an example here, here's what I want to show you guys. As an example, I'm going to go a little rogue here. Let's pull up NVIDIA. What would NVIDIA have to sell for to get 16% potential returns? Let's pull it up right now because everybody wants NVIDIA. Everybody thinks NVIDIA is the best thing since sliced bread. And I made really high assumptions here. Let's go 16, 26, and 35% returns. NVIDIA is currently at 150. It had to sell for $22, $24, and $26 to get those kind of returns because that's what I did here on my desired return.
Wow.
That's how much it would have to sell for to have this potential. So according to my stock analyzer tool, this is like paying mid-20s for NVIDIA. Mm-hmm. Company number 4, PayPal. This is a $1.5 trillion fintech engine trading like it's washed up. But don't be fooled. With over 400 million users and 200 million merchants, PayPal still printing cash, generating over $5 billion in free cash flow. They own Venmo, which is growing. Buy now, pay later is expanding, and they're targeting enterprise clients with their new payment platform. And by the way, they're buying back $5 billion of their own stock this year, which I think is wonderful when you're selling at these valuations. Mm-hmm. Now, guys, metrics, $75 billion company, $125 billion enterprise value, $6 billion in free cash flow last year, 5.2 in the last 5 years average. My whole point is, how does a dying company increase its free cash flow? Same with net income. When I hear this, I just chuckle. It's selling for 12 times free cash flow. Returns on capital, getting better, which means they're getting better and better returns as time goes on the money invested in the business. Very consistent profit margin. Mo, look at this. This dying company has averaged 7.3% per year in the last 3 years of revenue growth, 11.8% over the last 5, 14.5% in the last 10. Mo, one of our biggest 28 community members have this rated as a buy. Interestingly enough, not a single member has this as a sell or strong sell. So either we're all drinking the same Kool-Aid or we're all going to make a lot of money.
Exactly.
Who knows? 8 pillars, 8-pillar thriller. Now, this one has a lot of banking aspects to it, so you have to understand that I don't know if I can exactly look at these the same way, but I love the fact they've bought back 16% of their shares.
Especially at these prices.
And by the way, they got as low as $55 a share just a few months ago. That's what's incredible.
Yeah.
Now, analyst estimates. $5.20 a share, $5.76, $6.50, $7.23, $8.43. According to analysts, this dying company is generating double-digit increases in their earnings per share every year and revenue growth in the mid to high single digits. And by the way, not that it matters, but it's the number one held stock in our community of 3,500 people.
So I actually want to go back to the buying shares back.
Yeah.
If you look at the shares outstanding, can you pull that up on your screen and just go to the bottom? You'll notice that they've been slowly buying back shares through like 2021, 2022, and then they started more aggressively buying them back. And if you correlate it to the stock price, which this stock price, remember how crazy it got?
310, I think, was the high.
Yeah. So they weren't buying back shares at that time, but they're buying them back after 2022 when we started to get this very low prices. That tells me that they're good allocators of capital.
Guys, it's very hard to find companies that buy back stock when the stock is cheap. Most of these companies are buying, like NVIDIA, I think, is buying back stocks. Like, what are you doing buying back stock?
Right.
At nosebleed valuations. Mm-hmm. This doesn't make any sense. But either way, this is what's great. Mo, take us to the promised land for chart trading.
So this is a crazy chart, and this is very indicative of stocks that you saw just go absolutely wild during COVID in 2021, 2022, and then they come crashing down. And since PayPal came crashing down, you can see it's like all of these other ones. You see, it's very common in this market that you see stocks that are just stuck in a range. And PayPal is kind of stuck between that just over $90 a share and $50 a share. So this, to me, because it has more spread, it has a bigger price movement, not like Ulta where you had about $19, $20 to move. You can get really nice runs on this. You can short it down from 90 to 50. You can ride it back up. this is something that in the trading community, we trade often. I love trading PayPal. It's a good one just because it has those really nice price fluctuations, and it's usually pretty gradual. It goes from like 90 and it'll go down to 50 and it'll go back up. It's not just this jaggedy, bouncing all over the place thing.
All right.
Yeah.
So from a fundamentals perspective, what is the right price? Guys, 10-year analysis, I did 3, 6, and 9% revenue growth. Profit margin, I did 13, 14.5, 16. Free cash flow, it's higher than the profit margin. I did 16, 19, and 22. I went a little bit higher because in the last 10 years, they've done close to 20. And with a high gross margin, they can start really adding more money to the bottom line. PE, I did 14, 17, and 20. Again, my 9% return. The stock's currently at 74. And I have a low price on the cash flow basis of 60 to 75. High price of 150 to 203. Middle price of 95 to 125. Well, look at this. Another mid-double-digit potential return company here.
Yeah.
The question is, are they sticking around to do that?
That's true.
That's the question. Stock number 5, Adobe, the company that everybody's been telling me is going to absolutely go away because of Zero. Guys, this isn't just Photoshop and Premiere anymore. With its Creative Cloud suite, Adobe locks in millions of users through insane switching costs. They're adding in AI tools like Firefly and Sensei, and they're boosting productivity and pricing power. Plus, their digital experience segment helps businesses supercharge marketing, and with over 40% operating margins, not gross margins, operating margins, leads to monster free cash flow and steady buybacks. This company could very well be a compounding machine. It's not flashy, which is kind of hard to find with tech, but that's the point. The market's chasing other AI and saying Adobe's going to lose because of AI. Well, you know what Adobe's doing? They're just printing money. So let's go through these numbers here. Mo, look at this. This is a company that did $9.4 billion in free cash flow last year versus 7.35 on average for the last 5 years. Look how much higher their free cash flow is than net income.
Wow. That's
significant, 50% higher.
It's not super common that you see that.
It's not.
Yeah.
Returns on capital just broke 30% for the last year.
Wow.
You've got market cap of 167 billion, enterprise value in my calculation of 178, which means they can pay off their debt in 1 year of free cash flow. 89% gross margin.
That's monstrous.
Guys, every extra dollar they sell, 89 cents of it goes to the bottom line before overhead and income taxes. That's incredible. Yeah. A company like Microsoft's in the 60% range. This is insane numbers. Absolutely insane. We have 20 community members here who have it as an average rating of buy. Nobody has it as a sell here. Let's go to the 8 pillars here. See what it looks like. Okay, guys, feels expensive. PE, the price of free cash flow is almost a check mark. Almost a check mark here. But again, let's see what analysts have them as growing their earnings per share. Look at this, Mo.
Oh, wow.
11.5, 12, 12.5, 10, 10. Is that a premium company? Probably. Revenue growth? High single digits all day.
That's really big for a company that size.
Correct. Mo hit that on the head. It's hard for companies of this size to grow like that, and it's very hard for them to go to zero.
Yes.
So Mo, what do the charts tell us about Adobe while I pull up our stock analyzer?
So the interesting thing about Adobe is I keep talking about these kind of this consolidation channel. We're here on kind of the bottom of a consolidation channel. I actually like Adobe. I'm going to put this on my watch list, and I don't really do that very often, to go long at some point, because I think this can get back to 500, maybe 550 a share in the pretty near future.
Wow.
Which will be pretty interesting. Not saying that it's going to stay there, but I can trade it up there, which...
And then when the notifications are sell, what do you do?
I go short on it. Write it right back down.
Exactly.
So if you're interested in some things that I'm saying here, I have a full course that's pinned in the description below. It runs you through everything that you need to know about what I'm talking about right here. It might sound like Chinese to you, but it might also sound a little bit interesting. Go check it out. I think you're going to enjoy it, and we'll chat.
So guys, stock analyzer tool. Mo, revenue growth numbers, 4, 8, and 12%.
Okay.
Profit margin, 26, 29, 32. Don't care about it because it's so low.
Right.
Look at that free cash flow, 38, 40, 42. PE, 18, 21, 24. And by the way, Mo, that could very well be very low.
I look at your numbers and I go, yeah, maybe that's a little low, but for this exercise, I'm sure it's fine.
If somebody told me 20, 23, and 26, I'd say, okay.
Just
Like,
after
I
looking
wouldn't
at
argue with them about
after
that.
looking at their metrics, after looking at that gross margin, I'm just like, okay.
And it's a company that's naturally growing by itself.
Yeah.
It doesn't need to make tons of acquisitions.
Right.
In fact, let me show you that right here, because we do talk about that here. Their growth in the last 3 years has been 10.6% a year, 13.5% for the last 5 years, 17.9% in the last 10. Their acquisitions only $2.8 billion over the last 5 years on $167 billion. It's 1/4 of their free cash flow in the last year they spent in the last 5 years
Right.
total.
It's so negligible.
So they're growing on their own.
Right.
They're not acquiring to grow. That's why we have these metrics here. So again, back to Stock Analyzer. I hit the analyze button. The stock's currently at 389. I have a low price of 250 to 370, high price of 705 to 925, middle price of 400 to 584. 14.5% return on the middle side, low side 8.27. Seems pretty good to me.
yeah.
Stock number 6 is a stock that we haven't been talking about a lot. I haven't been seeing a lot about it on the markets. Alibaba, $200 billion Chinese titan, and it's already up 34% year to date. They control over 50% of China's e-commerce and run a lean, high gross margin model. But the real story is their cloud division leads China's AI enterprise wave. There's a lot of runway ahead for it too. Ant Group dominates fintech. They've got $80+ billion in cash, and a $25 billion buyback is underway. Guys, the company's only 207. By the way, remember when this market cap was like 130 billion?
Mm-hmm.
Isn't that funny?
Yeah.
It was like 140 billion, I think it got
Yeah.
to.
Yeah.
How things have changed.
Yeah. How the narrative has changed.
The narrative has changed. Guys, I don't look at this as a huge gamble. I look at this as thinking to myself, okay, a cash-rich company in a market that has amazing growth potential with the fastest growing middle class in the world, arguably the fastest growing probably millionaire class in the world. So let's break this down on what makes this one of the best possible value plays hiding in plain sight. So guys, like I said, $270 billion market cap. Their return on invested capital is starting to climb back up again. Last 5-year average, $17.9 billion in free cash flow. Big hit last year to down to 6.7 billion. But you look at this thing, it's selling for 15 times free cash flow. Mo, when it was selling for $70 a share, that's essentially like getting it at single digit. It's not essentially, it was single digit price to free cash flow.
Yeah.
Guys, China is scary. We don't know China. We don't know what's happening there. They are still communists. I get that. But you know what's amazing to me? What I love about communists?
What do you love about communists?
They love money. They love money so much. They're the biggest hypocritical assholes of all time. They love money. And they're going to keep going to where the money is. People in China realize how much fun it is to have money. Mm-hmm. And their average income is growing like crazy.
Yeah.
Yes, they had a decline in population last year for the first time in like 60 years, but you still have a country that can grow its per capita GDP like crazy. And if you don't think that's possible because the population is declining, you're not a student of history. It's absolutely possible. Guys, if you're new to this channel, we have one more company to talk about after this, and we're going to keep talking about Alibaba. You've got to remember that it takes a shift to get this mindset. You're fully capable of it. You don't need to be some brilliant PhD. In fact, if you had a PhD, I'd be more worried about your ability to be an investor because you're an overthinker. It's about finding good companies at great prices and sticking with them through thick and thin. That's the hard part. That's why we have the community here, because then people can talk to each other and keep each other motivated and on track. Let's look at some analyst estimates here. I'm actually surprised about this one. 933 to 1357. Not much growth. It is double digit, by the way.
Yes, it is.
It is double digit. And revenue growth is kind of choppy here. Not much revenue growth here either.
Surprising.
Very surprising. But if they do the same thing for their business that Amazon did with AWS, they're going to print a ton of money as time goes on with not much increases in their revenue. So Mo, before I go into our stock analyzer, what do the charts say?
So I personally don't like to trade Chinese stocks, and here's the reason. The way the data translates over, you can see these gaps all over the place. It's something that comes into the software, therefore I stay away from them. But there's something important I can show you here. I keep talking about that volume. When we got this was kind of this 112, 115 level. This was the resistance point that we couldn't get through. Notice we spiked up here to 140, 145. And look down here, look at the volume. Look how drastically that volume increased. So when I say that you need a ton of volume pushing into the stock when you want to drive through these resistance points, that's what it takes. Even right here, this was in probably April. You had the same thing, big spike in volume. What happened to the stock price? It ran up. So this is a good example of what the volume looks like on a chart.
All right, good. I never heard you say that about Chinese stocks.
Yeah. It's like when you look at like Adidas or Nintendo, those kind of companies. Japanese, they bounce around. No, I just meant foreign.
Foreign, got it.
The way the data translates over, it just bounces around. It's too choppy. It's hard to catch the trend.
Got it.
Yeah.
So guys, so far we looked at 6 companies, and they're, I think, incredible companies. But I do not care how great a business is. I'm not just paying any price for it. That's the mentality you have to have. That's not how real investors build wealth. You need to understand the business. More importantly, you need to understand the valuation. And we have a system for doing that works, no matter what the market's doing. But I want to remind everybody, it is amazing to me that when I hear all these stories about what's going on in the market, the thing that actually is the most important with an ultra high correlation is valuation, and people tend to ignore it. Back in April, the market pulled back and fear was everywhere. Headlines went nuts. Most people froze, but not us. They panicked. We had a plan. We talked about it here. Guys, but 25 years ago, I was like the regular person out there. I was chasing stocks, following tips, getting caught up in the hype, hoping something would stick. That's not investing. That's gambling. And that's exactly why Everything Money was created. I wanted to give people like me from 25 years ago the tools, the strategy, and the community that's needed. Joining Everything Money gets you access to this software, gets you the private group of serious, like-minded investors who aren't guessing. Let me be clear. This is very, very important. If you're the kind of person just looking for a shortcut, looking for somebody to give you a tip, we're not for you. If you want to learn, get better, we're for you. If you jump from shiny thing to the next thing and over, we're not for you. If you're willing to put the time in, realizing that getting better and learning is part of the fun process and stick with it, this is for you. We're building a community of committed investors who are in it for the long haul. In fact, we've had internal conversations about making this an application-based software. You have to actually apply. It doesn't mean that you have to have some amazing portfolio. It's about, is your desire there to learn? That's all I care about. If you want to learn, we're the place for you. And we want to learn from you. So if you want to start out, click a 7-day trial. We haven't done this application process yet. You can get in, click the link below. Spots are limited every day though. So you have to jump on it and get into it. So if you're serious, now is the time. Now, Mo, I did 3, 6, and 9% revenue growth on Alibaba. I did 12, 15, and 18% profit margin. I did 15, 18, and 21 on free cash flow. Because as you can see, in the last 5 and 10 years, free cash flow was higher than profit margin. PE, 15, 17, and 19. And I think I'm being conservative because of China. And I did 9% return.
Okay.
Hit the analyze button. Low price of 107 to 133, high price of 290 to 340, middle price of 180 to 215. Another potential double-digit returner. Now, guys, the 7th and final stock, Nike, the go broke, go woke, go broke company that everybody accuses them of being. Guys, Nike is a global cash machine. They own 40% of the athletic footwear market. They're not just doing the Air Jordans. They're doing direct-to-consumer push, which is boosting margins, while also expanding their women's wear and apparel. But the real lever is that international market. Yes, it's been tough lately. But guys, do we think that's going to last forever? I don't. They're making AI-powered personalization. They're bringing in more supply chain efficiencies, strong free cash flow. It just announced earnings, and they said they think the worst is behind them in terms of tariffs. And guys, guess what? They're buying back aggressively because they realize how cheap their stock is. Mo, remember when we did this company? It's currently at $71 a share, got as low as $52 back in April during the bottom of the market. It got to 180. We were making videos saying, hey, we're interested sub 100, we'll take a look. And what do people say?
No chance it's ever going to get there.
No chance. Nike's huge.
You're
too greedy. There's no way that's going to happen. You're going to miss out. Then at $55 a share, Nike's dead. They're terrible. Probably not the same people, but probably the same people, the same type of person. This company has amazing potential. Guys, returns on capital, 18.8, 21% last year, getting better. You have margins, very consistent, a little bit lower than recent, but guess what? We had tariffs. That was a freaking issue. Price to free cash flow of 20. Mo, when it was at freaking 180, what was that price to free cash flow?
Yeah, I loved when it was at 180. I loved it.
People were just like,
People were like, you guys don't know what you're talking about.
And maybe we don't.
Maybe, but I mean.
We have 36 community members who voted on this, and we have some people rated as a sell. But overall, the average
Yeah,
is a buy.
I would love to know their reasoning. If you have that, I would love to know a comment on that.
Well, the great thing about a community is there are people who just blatantly disagree. There are people in our community who love Bitcoin.
And I think that's great.
Absolutely. So let's look at the 8 pillars here.
Okay.
8-pillar thriller. Yeah. Everything's a check across the board. Buying back shares.
Awesome.
Yes, I don't have to go through anything else here. This is just great. They're growing revenue. They're growing profit. Yes, there's actually revenue over year is down, but they think the worst is behind them there.
Yeah.
Let's see what analysts think about the company. Earnings per share, basically over double, 215 to 523 a share in the next year. And they have the 43% drop this year and an 8% drop next year. Okay. Revenue growth, dropping, and then going right back up again. I mean, maybe. Here's my point about Nike. Any company we've talked about today. Would you be surprised if they were gone in 20 years? I'd be absolutely floored
100%.
if Nike did not exist in 20 years.
Yeah, 100%.
So then the question is, are they going to have bigger revenue and bigger profit 20 years from now than today?
I mean, I would say yes. But
I would say yes as well. So if that's the case, what's the right price to pay?
yeah, I think with a lot of companies like Nike that do a lot of business in China, I think people put too much emphasis on what they do in China. If you just go and look at their 10K, they do a lot of business in Vietnam. They do a lot of business in other countries that are not just China.
So you know what that's an example of? News follows the stock price.
100%. I remember when this went to $52 a share, I was like, man, it must be really bad. I pulled up the 10K. I was like, that's all that they do in China?
But that's the thing. You
yes,
attach
please.
yourself.
Yeah.
Remember ADRs for Alibaba.
Yes.
If you own Alibaba, you're going to lose all your shares. No, I'm not. I literally called Merrill Lynch and you called Schwab,
Yeah.
and they're like, no, the shares just go to Hong Kong and we have to just transfer them over. That's it.
Yeah.
It's like if you ever want to sell them, we have to sell them
Takes
and
an
transfer
extra
you the
day.
money. Oh, that's it? Yeah, that's it. It's just people attach themselves to a story and they blow it out of proportion.
Yeah.
Mo, what do the charts look like on
So
Nike?
this is one that I actually traded recently, and it was because it got to this $52 area, and I said, okay, this is below COVID lows at this point. Everything's blown out of proportion, and I ran it up to about $70 a share, $65 a share, I think it was. But it was in a short amount of time, and the purpose that I did that was because I just didn't think, I thought it was just, again, blown out of proportion. I took advantage of it, and the trend was going in my direction, and I said, hey, let's do it.
Okay.
Quick turnaround.
So here's a stock analyzer, guys. I did 3%, 5%, and 7% revenue growth, but Mo, look what I did. I did a 20-year analysis.
Oh, because you want to, because
I
they're
wanna
going to
look
be
at this-
around for 20 years.
Yeah. So this is something I did. Profit margin, I did 9, 10.5, and 12. Keep in mind, Mo, I think 12 is a lot closer than people think because of this direct-to-consumer stuff. Because now they don't have to sell it to a
There's
wholesaler.
no middleman. There's not 5 middlemen.
They can now spend the money on advertising and pocket all that money.
Right.
PE, I did 19, 22, and 25, and I did a 9% return. I hit the analyze button. $71 a share. Mo, I have a low price of 50, high price of 128, middle price of 80. It's pretty decent here for a company like Nike to be able to get a double-digit return.
Yep.
Now, guys, if you're still watching this, then you're clearly a serious investor and you're not just chasing hype. So why stop now? This next video is our full investing course where I show you exactly how I find undervalued stocks before the crowd catches on. The 7 stocks we did today, I guarantee you there will be a time when people are all in on those stocks. It just takes a while. You're going to learn how to read financials the right way, how to avoid overpriced traps, and build a portfolio that can compound for years, not months. So if you're serious about long-term investing, this is absolutely the next step. Click the video on your screen. Thank you so much for your time.